Hello everyone and welcome to This Week in the Markets. This week the spotlight has been turned back to Europe again, so we'll spend a bit of time discussing the developments there and whether the market's fear is justified or unfounded. Then we'll also have a brief discussion of the earnings seasons in US. This is third week into the earnings seasons and a lot of companies have reported their earnings, so we can get a good look of what the earnings quarter is like this season. But before then, I just have to go through our disclaimer. So information contained in this video is intended to be general advice only and should not be relied upon as financial product advice. Furthermore, the advice has been prepared without taking into account your objectives, financial situation, or particular needs. So you should, before acting on the advice, if you choose to act, consider the appropriateness of the advice having regards to your objectives, financial situation, and needs. So last week, the market was worried that Spain might come closer to a full-fledged bailout, because on Friday, Spain's eastern region of Valencia officially requested financial aid from the central government. While Valencia might not be the straw that breaks the camel's back, other regions such as Catalonia, Murcia, and Andalusia could soon follow the lead to request financial help, because these regions are also finding difficult time funding themselves. Together, they could pose some considerable pressure on the Spain's sovereign balance sheet, and might force the country to request more bailout fund from the Eurozone. The market responded to this by pushing the Spanish 10-year yield to a new high and above the psychological 7% level, where other countries have previously requested bailout in the Eurozone. This also had a contagion effect on Italy, who saw its 10-year bond yields rising to a 6-month high, above the 6.5% level. And to add to the mounting fear, on Monday, Moody's lowered its outlook on Germany, Netherlands, and Luxembourg, which is the few remaining AAA countries in the Eurozone. Although these countries still kept their AAA ratings, their outlooks have been cut from stable to negative, as Moody's warned that the cost of bailout could fall most heavily on these richer nations. While the situation in Europe looks to be quite bleak and nowhere near settled yet, but we actually think that the credit conditions there are actually improving on the margin. If we look away from the media hype of Spain and Italy and turn instead to Portugal and Ireland bond yields, which is where the market was focusing last year, you see on this first chart the Ireland bond yields and the next chart, which is the Portugal 10-year bond yields. They've both been moving lower and quite sharply from the peak last year. And also, if we look at the Euro swap spread and the basis spread, the white line here is the 2-year Eurozone swap spread, which is like a measure of European banks' ability to borrow in US dollars term. And the yellow line is the 2-year basis swap spread, which is like a measure of the bank's ability to borrow amongst themselves in euros. So we see that according to both measures, the credit conditions in Europe are actually improving, which is quite contrary to the doomsday scenario that we are led to believe. In US, the earnings season produced quite a mixed result last week, as many of the large US corporations reported their earnings. We had companies like eBay, Microsoft, and General Electric reporting stronger than expected results, but on the other hand, Apple, AT&T, and UBS came in below analyst expectations. So far in the earnings season, 217 companies out of the S&P 500 have reported their earnings, and the surprise factor have came down quite a bit since 2 weeks ago to 3.79%. We can see that revenues was the weakest link this quarter, as a lot of the average sales reported by companies have been below analyst expectations. This is slightly bearish for the stock market because it suggests that economic activities are not that strong, and profit came largely from cost cutting, which also helps to explain the lower labor rate in the market. While it is still positive for companies to exceed profit expectation this season, there is only so much companies can do to cut their costs, and eventually growth needs to come from sales. But on the positive side, the Fed will hold its monthly meeting next Wednesday, which is on the 1st of August. These weaker than expected earnings and also the weak housing markets which we have seen last week might actually convince Fed officials to take on more aggressive easing and maybe convince a few to err upon the line of quantitative easing. The Bank of England and the European Central Bank are also scheduled to meet on Thursday, so that will be quite important as well. And on top of the central bank meetings, The coming week will also be quite a busy one in terms of economic news. In particular, we need to watch out for the GDP data in US, which will be released tomorrow, and also the ISM manufacturing report, which will be on the coming Wednesday. There are also some important economic indicators from Japan and Europe, so keep an eye out on those if you have exposure to them. And so that's all from us this week. Next week, we're going to have another video update for you. Until then, on behalf of the Trading Pursuits team, we wish you all a profitable trading.